The S&P is down 3% today and has seemingly fallen off of a cliff. Some of the most popular retail stocks, like Tesla, are also down 8% and a further 1.7% in after-hours trading. Even my own largest position, Brookfield Corporation, was down 6% at the market close. The reason stocks are selling off so much is because the Fed lowered interest rates by 0.25% and gave the outlook for only 2 quarter-point interest rate cuts in 2025. This is a full half percentage point below what the market was expecting in terms of further interest rate cuts for the next year. Or in other words, the market was expecting and pricing in much larger interest rate cuts in 2025. This news has caused bond yields to spike and stocks to sell off rapidly. What's also interesting is many banks and analysts have been getting increasingly bullish on the S&P for 2025 and increasing their price targets all the way up to 7,000 now. US stocks have also seen record inflows of $448 billion so far this year, which suggests that investors are selling international stocks and moving more and more of their capital into the US markets and indexes. These massive inflows have led to the largest stocks in the US, like Apple, trading for extremely high price-to-earnings ratios of 40, despite Apple's business not seeing much growth over the past few years. This has also caused the price-to-earnings ratio of the S&P as a whole to reach 31, which is only 10% away from the price-to-earnings ratio that the S&P was trading for during the tech bubble. This is all to say that the market has become very expensive and priced for perfection. So now that the Fed has announced lower interest rate cuts than the market was expecting, it's caused a bit of a panic and sell-off in stocks. So in today's video, I want to discuss the stock market volatility, what I am doing now, what my expectations are for 2025, and really what my strategy is going to be going forward, and also how investors can detach their emotions from the stock market volatility so that you can start to view the volatility for what it is, which is opportunity. So this is going to be an action-packed video, so let's just hop right into it. All right, so first I want to discuss what I did in the market today, and I just purchased some more Brookfield Corporation. I simply could not help myself after seeing the stock was down 5% at the time that I purchased it, but I still think that Brookfield Corporation is a high-quality business, and it's the same business that it was yesterday. So now that the stock has sold off 6%, it's simply allowing me to buy shares at a cheaper price and ultimately higher future returns. So this is a stock that I have added to my portfolio during the pretty much crash that happened today. And I wasn't planning on buying more Brookfield today, but again, I saw the stock down 5% and I simply could not help myself. I have also been continuing to buy select stocks in my portfolio over the past month, and I'm not someone who tends to sit on a lot of cash or try to time the market. I am someone who believes that there is always value somewhere in the market, and therefore I like to add where there is value. And if the market does continue to come down for the remainder of the year, and if it does see a real correction in 2025, then I am simply going to continue buying stocks and hopefully we can see some more value in the markets if that does happen. I've also noticed that a lot of newer investors tend to get worried or fearful when their stocks go down, especially after they just bought them. I actually did a big video for my Patreon members a couple of days ago because one of my Patreon members said that they purchased him stock, and then the stock fell 10% and they weren't sure if they should sell the stock now or continue buying it. And this perspective of not knowing what to do after a stock falls or during a stock falling is a reflection of the investor focusing on the share price and not the business behind the share price. And how you detach your emotions from the daily volatility or stock prices falling is you increase your conviction in the business and you focus on the business behind the share price. So I'm going to show you guys the example that I used in my recent Patreon video with GoEasy, because this is a stock that I have continued to add to my portfolio, and I've been continuing to research it and build my conviction on this position as the stock has come down. And if we take a look at GoEasy's year-to-date performance now, it's up only 2% on the year. This is at the same time as the S&P is up over 20%. So far year-to-date, GoEasy has significantly underperformed the S&P 500. The highest the stock traded for was $205 per share on July 3rd as well. This means that the stock is now in an over 20% correction from its all-time highs. And if I were a newer investor, or if I were someone who based my investing on what the share prices of stocks was doing, then I would look at this 23% correction that GoEasy stock is in and become fearful or become emotional that This position is underperforming the overall S&P. It's down 23% at the same time as the S&P has been continuing to rally. And this could cause me to become fearful, worried, or downright pissed off at this position and not know what to do. But this is not the way that I invest. How I invest is I don't look to the share price performance in the short term. What I do is I look to the business behind the share price to see if it is creating an opportunity and if the fundamentals of the business are actually continuing to grow. So if we head over to GoEasy's financials really quickly, we can see that its revenue is continuing to grow and hit all-time highs. The revenue growth for this business has been incredibly consistent, and in the most recent quarter, nothing has changed. The revenue is continuing to go up. If we take a look at GoEasy's operating income, this is the exact same story, and it's hitting fresh record highs of $581 million as of the most recent quarter now. Now, lastly, if we take a look at GoEasy's net income, we can see that it is clearly continuing to go up. And in the most recent quarter, it hit another record high of $284 million in the trailing 12 months now. So now let's take a look at some of GoEasy's KPIs. And here we can see that its total gross consumer loans receivable, or essentially its loan portfolio, is sitting at a record high of $4.4 billion and continuing to grow strong. This ultimately means that GoEasy is continuing to grow its business, and it is still seeing strong demand for loans from its customers. Next, let's take a look at GoEasy's gross loan originations on a quarterly basis. And here we can see that in the third quarter of 2024, the company had a record high for loan originations of about $840 million. So GoEasy is currently seeing a record demand for loans, and the business's loan portfolio is continuing to grow. In addition, with its revenue hitting an all-time high, operating income hitting an all-time high, and net income hitting an all-time high. So literally the fundamentals of this business are at an all-time high and they are continuing to grow. Now, additionally, at the beginning of 2024, GoEasy put out their revenue, their loan portfolio, and their operating margin. And then in the second quarter of 2024, they upped that guidance for 2024, 2025, and 2026. And then in the third quarter, the most recent quarter, they maintained their increased guidance for 2024 and their 3-year guidance out to 2026. So this business is continuing to see strong demand, and its margins and profits are continuing to remain stable, and their outlook is remaining stable as well. And what all of this research that I have done into GoEasy's business has resulted in is my conviction growing at the same time as the stock has come down, which ultimately creates an opportunity for me. This business is now trading for a price to earnings ratio of only 9.63. And analysts are also expecting it to generate around $20 in EPS for 2025, which means that it is now trading for a forward price to earnings ratio of about 8, while the business is still projecting around 15% annual growth. Now, that was kind of like a quick summary on all of the recent research that I have done on GoEasy. It really goes a lot more in depth. I've done a lot of videos for my Patreon, and I've also discussed the stock a lot with my Patreon. So I'm not going to rehash all of the recent bear thesis that people are coming out with and me looking into the bear thesis and whatnot. But the moral here is that for you to view falling stock prices as an opportunity, you have to remain focused in the business behind the share price. If you're looking to the share price to make your investment decisions, then you're going to just be acting in a constant state of response. You're going to be responding to what the share price is doing. Now, what I have also been suggesting to my YouTube channel is that I think that this is a time where investors should be trying to increase their conviction in the stocks that they own, because there is a very real possibility that we could see another real correction in 2025, just like we saw in 2022. And it helps to have your convictions solidified before these corrections come, because then you're not needing to redo all of your research or confirm your conviction in the positions that you own and in your portfolio, and your conviction will already be strong, which allows you to quickly capitalize on opportunities when they do come, because you want to be prepared before the stock market corrections actually come. And that's pretty much the entire moral of this video, and that's kind of what I wanted to put out, is I think that we are in a market where people just need to increase their convictions and get prepared for some potential stock market weakness, because the market is pretty high right now. And, historically, when the market has been this high, we do see corrections or we see a period of low stock returns. And it's in those types of markets that people's convictions will be tested. So I like to make sure that my convictions are solidified before they are tested. So to wrap up this quick video, I want to read you guys a couple of pages from my book, The Fundamentals of Investing, and specifically the first few pages of the chapter, The Investor's Perspective on Volatility. because I think that this chapter can really help you detach your emotions from stock price movements and ultimately get you perceiving falling stock prices as a good thing and as opportunity. So let me read you guys the first couple of pages here, and it starts off with a quote from Charlie Munger where it says, "If you're not willing to act with equanimity to a market price decline of 50% 2 or 3 times a century, then you're not fit to be a common shareholder, and you deserve the mediocre results you're going to get. Your perspective is the lens through which you view the world. This chapter is going to be dedicated to changing your perspective towards stock market volatility to emulate how the best investors throughout history have perceived it. Most people perceive volatility as a risk, but in reality, it is what creates investment opportunities. Volatility causes many people to become uncomfortable and worried about their investments. This can cause them to make emotional decisions based on what stock prices are currently doing, instead of making rational decisions based on the fundamentals of the businesses they own. Why is volatility perceived as a risk? Because every stock will go through periods where they fall 30%, 40%, 50%, or even more. If you give in to fear and sell when your stocks are down, then you allow volatility to create losses. You could own the best stocks in the world and still lose money if you allow your emotions to get the best of you and sell just because stock prices have gone down. You have to become comfortable seeing your stocks decline if you are going to succeed as a long-term investor, because it will happen to you. This is something you need to accept and come to terms with, because there is no avoiding it. For you to never see the prices of your stocks decline, you would have to time the exact bottom on every stock you ever buy for the rest of your life. The odds of that are next to impossible. Therefore, you will almost certainly see your stocks fall, and on multiple occasions. Since you cannot time the bottom, you should not feel remorse or regret if a stock declines after you buy it. It is so easy to let the voice in your head say, "I should have just waited. I could have timed this so much better. Was I wrong? And what should I do now?" But you have to realize that this voice is driven by your emotions, and it is trying to get you to make decisions that are based solely on short-term price movements. The key to being a successful long-term investor comes from being able to stay rational when other investors are letting their emotions get the best of them. In fact, Warren Buffett believes that successful investing is more about controlling your emotions than having a high IQ, and I agree with him. A genius is a man who can do the average thing when everyone around him is losing his mind, which is a quote from Napoleon. Fear clouds your mind with doubt and worry, making it difficult to see the opportunities passing by. Therefore, you have to remain optimistic about the future when stocks are falling, and you have to trust that humanity will overcome the countless problems that we face. An optimistic mind allows you to be hopeful that difficult times won't last, and that better days will come. This enables you to spot and seize opportunities even amidst challenging times, since you know that they are only temporary. Remember the story of how? That was a story I wrote about earlier on in the book. To take this one step further, the best investors do not just have the ability to remain calm when stocks are falling, they enjoy it. These intelligent investors have shaped their perspectives to view falling stock prices as a good thing for their long-term returns. They gain this perspective by understanding that as stocks fall, their future returns increase. As a long-term investor, your best returns often come during times when the market is in turmoil and everyone is predicting doom. For example, take a look at figure 9.1, which shows you the price chart of the S&P since January of 2006, and ask yourself where the best opportunities to buy were. It is natural for your attention to be drawn to the points where the stock market experienced significant lows. This is because buying during the declines gives you the opportunity to buy stocks at cheaper prices and gain higher future returns. The slope of these lines in figure 9.2 show you the rate of returns investors would have received based on where they bought the S&P and held it to 2022. If you had bought the S&P during the peak in October of 2007, you would have had an annual return rate of 5.83%. If you bought the low in March of 2009, you would instead have an annual return of 11.75%. This may not sound like a huge difference, so let's put this into perspective. If you had invested $1,000 at each of these points in time, your investment would have grown to $2,340 if you bought in 2007, whereas it would have grown to $5,290 if you bought in 2009. So you would have more than doubled your returns by investing in the S&P when it was at a lower level. To put this simply, the lower you bought the S&P, the higher your returns would have been today. So to summarize the beginning of that chapter in my book, it's that the best investors in the world view falling stock prices as a good thing because they know that it increases their future returns. And this is also another thing that I really wanted to highlight in this video, is that as stocks fall, your future returns actually go up. And therefore, if you are someone who is a net buyer of stocks, you should be wishing for lower stock prices because it will increase your future returns. And just think about the correction of 2022 and how many great buying opportunities were created when the market was down 25%. Google was trading for a price to free cash flow of 15, and the stock has more than doubled since then. Amazon was also trading for a 10-year low price to operating cash flow, and the stock has more than doubled since then as well. Brookfield's Corporation was also trading for $40 Canadian, and the stock has now doubled since then. So it's in these large stock market corrections that we actually make the best returns. It just doesn't feel like it at the time because when we're buying, stocks are currently going down. So I hope that this video was helpful and also helps you shape your perspective on volatility to start viewing it as opportunity, just like the best investors in the world do. But I feel like I have rambled quite a bit in this video, so I'm going to wrap it up. But I just wanted to chime in and make this really quick video. I wasn't planning on making this video at all today until I saw that the market was down 3%. But I just wanted to kind of help people ease their emotions because my portfolio is down quite a bit today too. But I am using this as an opportunity to continue buying stocks that I have high conviction on. So if you did enjoy this video, then please remember to leave a like on it. And if you're interested in getting a lot more stock market commentary and a lot more content from me, then consider checking out my Patreon. You'll also get access to my portfolio and all of the buys and sells that I am doing in real time. People have been absolutely loving my Patreon, and I'm actually considering raising the price next year. So if you do want to get in before I increase the prices, then you should go and join now. But that's going to wrap up the video for today, everyone. So thank you all so much for tuning in. I truly do appreciate it, and I hope to see you all again in my next one.